The weight of money argument is not just a figure of speech. New entrants to the market are well armoured and well resourced, and they're moving into dragon-filled sectors like retail with swords slashing energy. Here are 3 examples. So this week, Norges Bank, the Norwegian sovereign wealth fund, was revealed to be in talks to buy the remaining 50% stake in Sheffield's Meadowhall Centre, paying about 360 million. They bought the other half in 2012 for 348 million. Simultaneously, Blackstone, and beasts get no bigger than Blackstone, signalled a return to retail after a decade and a half of soft peddling in that sector, saying now was the moment of opportunity. Meanwhile, Pat Gunn, the Irish investor who co-parented Green Property and knows the northwest of England well, re-entered the UK property market after a very timely exit in 2019. He's now formed a joint venture said to have a £700 million plus kitty. At the same time as new knights errant take advantage of an unusual market, others are on the retreat. Pension funds and other UK institutional investors have been rethinking for a long time. Fund allocations to illiquid things like real estate are lower than they once were, and that's because we're all more short-time, more trigger-happy, more insistent on getting our money now. A lot of the slack was taken up by private equity, which thrived in a low-interest rate world, but could be about to face a day of reckoning of its own. This week, the Bank of England repeated scary-sounding warnings that higher interest rates plus stacks of unquantified debt was a risk to financial stability. The result is a dangerous terrain where the stakes are higher than ever, the risks and rewards unusually high too. Valuation has turned into soothsaying. At Salford's 205,000 square foot Trinity Bridge House office block, for instance, the market was being tested at £36 million this time last year, and it's now reported to have sold for 18 million or perhaps 25 million. Anyway, a great deal less than the price this time last year. Get it right in this kind of market, your fortune is made. Get it wrong, it's curtains. Adventurous knights like Gary Neville-fronted Relentless Group are scooping up the prizes. This week it claimed a 34,000 square foot letting to Leeds and Manchester serviced workspace operator Gilbacks at its Manchester St Michael's scheme. Others, and you can all Google, you can all find out, are doing the Black Knight's evergreen Tis But a Scratch routine from Monty Python and the Holy Grail. They're not doing so well, and it's all very undignified. These are strange and unsettled times, the like of which we may not see again. Take courage, bold knights, slay the dragons, and fortune is yours. If you don't, the dragons will burn you up. And now your weekly rundown of what's going up and what's heading the other way in the Place North elevator. Doors closing, going up. Yesterday saw one of the best data drops of the year, if you're a bit geeky. They are the GDP figures for the regions and for each local authority. The data, you can find it on the Office for National Statistics website, is well worth your time. The most striking data set is that for local authority deflators, which sounds unpleasant, but is massively significant. It shows the rate of change of the size of a regional economy or a local authority economy over time, rather than showing the big misleading headline numbers. So it works like this. GDP at whatever value it was in 2019 is set at 100, and the statisticians work backwards to say what proportion of 100 was represented by GDP in 1998, and then forward to 2022, the most recent year. So it's if today's figure is over 100, you've grown your economy since 2019. If not, not. So a few examples. Manchester is now 110.7, so it's up nicely, but by no means amazingly. Stockport, which started from a higher base as the century turned, ended up at 109.6. Nearly as good, but not as good. However, they're still better than Salford, which oddly started in an even better position than Stockport, but ended at 107.6, which is pretty low by regional and national standards. The longer-term picture is even more revealing, and we can look there at Darlington and Redcar, near neighbours but with very different outcomes, to see how this works. Darlington has seen a massive economic collapse. It was worth 167% of its 2019 economy back in 1998. But since 2019, it's barely grown at all and is scored at 102.5. Down the road in Redcar, very different. The century started with the borough in an average to weak position, but it's raced ahead since 2019. Measured by the rate of growth, it's a rocket and one of the North's fastest growing. It scored 113.8, so that's more relative growth than Manchester saw, and it grew at a rate comparable with affluent Cheshire and Westchester, one of the highest, which was 114.7. Sunderland's Riverside Quarter took a step forward this week with the appointment of Starker, the leisure property consultancy, to advise on 60,000 square foot plans for restaurants and bars. The scheme on the site of a leisure centre is backed by the government's Future High Streets Fund and is part of a wider venture to boost city living and city facilities in, surprise, surprise, the city centre. The prospectus for Riverside is nothing if not ambitious. They're aiming to create 1,000 homes for 2,500 people, 1 million square feet of offices and workspace for 8,000 to 10,000 quality jobs. Sunderland was one of just 3 locations to scoop the full £25 million grant available from the Future High Street Fund, largely because they showed the potential to leverage that into something much larger. It's more than encouraging to see that process get underway. So that's it for this week. We've seen how lingering inflation opens opportunities for property investors and developers with a thick layer of armour, applauded Sunderland's ambitious Riverside plans, and gasped at the unequal way 25 years of economic change has affected Redcar and Darlington. For more about the built environment in the North, visit placenorth.co.uk. I'm David Thame, and thank you for listening.